The dust is still settling on Didi Global's bombshell announcement that it will quit its New York Stock Exchange listing in favour of Hong Kong. Now, it comes barely 5 months after the ride-hailing giant's New York debut and is at the behest of Chinese regulators. Now, they worry that overseas listings could risk a potential data leakage. But analysts note there's a wider Chinese policy at play when it comes to the country's dealings with the US. Now, Lo Min joins us live now. Min, Didi is just one of the outcomes of this regulatory crackdown. Now, how does it define China's policy towards the US?
Well, the timing couldn't be more telling. It comes just after the U.S. Securities and Exchange Commission announced yesterday that it's about to put in place a law that would require foreign companies to open up their books to U.S. scrutiny or risk being kicked off the New York Stock Exchange and NASDAQ within 3 years. And way before that law is being put into place, Didi is rushing to delist, and that order came straight from Beijing 1 week ago. And the speed at which they're pushing this through really shows how seriously the government and the company is taking it. And in a way, that's not too surprising as well. It does fit into the growing trend of Chinese companies delisting or choosing to have secondary listings in Hong Kong or here in the mainland closer to home. And that's because Hong Kong and China are the only two jurisdictions now to refuse U.S. inspection despite Washington requiring that since 2002. And it also fits into President Xi Jinping's plan. He has been laying the groundwork for this since 2 years ago when he initiated the launch of the Shanghai Stock Exchange Star Market. The intention was to provide an alternative or to replace the NASDAQ in the U.S.
Min, you talked about speed there. Didi's departure from U.S. markets. Could it be a harbinger of more withdrawals to come?
Yes, experts have told me they predict that this would be the first of many other U.S. tech firms that could soon delist from the U.S. markets over the next few years. And that's because Beijing has made it clear it doesn't want its tech firms to be listed in the U.S. Because that puts them under the jurisdiction of U.S. regulators. And many of the firms listed in the U.S. now are in the tech-related industry. And you can imagine the amount of data they hold that Beijing is very concerned about. And so this could have huge spillover effect rippling through the $2 trillion worth of Chinese companies' shares that are being traded in the U.S. right now.
And with the reversal of this very high-profile listing, Didi, Chinese companies will probably think twice about going to the U.S., won't they?
Well, you know, Didi had ample warning for this. As far back as 6 months ago, Beijing had been nudging it towards listing in Hong Kong before they went ahead with a rushed IPO in the U.S. And so now they're turning into this postal child. They are a high-profile example of the kind of punishments that could be meted out by the government for any company that chooses to follow in its footsteps and disobey the government's wishes and list in the U.S. I also want to point out that even though Didi's shares has hit rock bottom, plunging 45% since June, experts told me that a lot of that political and regulatory risk is already priced into their shares now, and they expect that the IPO prices in Hong Kong to remain around this level or to even rise further because the expectation is the regulatory clamp down on Didi would loosen after it lists in Hong Kong, and that could bode well for its growth in the future. Eugenia.
Thank you, Lo Min, reporting from Shanghai. Well, Didi Global stock is strengthening from yesterday's lows. The shares are firmer in pre-market trade, up about 0.3%. They were earlier up more than 14%. The stock closed at $7.80 yesterday, 44% lower than its $14 IPO price. Well, Hong Kong has been tipped to gain from China's regulatory crackdown on foreign tech listings and the heightened U.S. scrutiny of Chinese firms. But to date, it's not quite the case. Ronan Lim explains.
Relocating to Hong Kong may not be a sure thing. Now, Hong Kong has a tougher listing requirements. That's one of the reasons why management at Didi chose New York in the first place. Previous discussions with the Hong Kong bourse operator here floundered over scrutiny about the company's mainland ride-hailing operations. Hong Kong also has limited usage of complex offshore structures to the relevant parts of a company's business, so compliance might actually require painful restructuring by Didi in order to list here. Now, the company could also be subject to data security screening. Now, China will be imposing a cybersecurity review on mainland companies seeking IPOs in Hong Kong on national security grounds. The new rules will be undergoing a public consultation later this month. Now, if put into place, this new regulation could also be introducing an additional regulatory layer for listings here in the territory. And while Hong Kong could be a beneficiary of China's evolving regulatory framework for raising capital aboard, but so far, any benefits has failed to materialize. Now, Hong Kong's markets for IPO have softened considerably this past year, and there are also indications that investors' appetite for Asian tech IPOs is waning. This after Singapore-based Grab's disappointing debut. After initially surging some 20% when trading began, the shares closed down for the day 23%.